Let's kickstart the show with a bunch of stocks which are not doing well, despite the fact that the entire market is doing extremely well. Britannia is one such. Why is that? Because CLSA, which already had an underperformed rating on the stock, has further downgraded the stock to sell. They have a target price of 4,060 odd rupees. Why is it that they are, circumspect on the prospects? One is that they believe that the inflation in wheat as well as milk may pose a risk to their margins, so much so that the consensus margin expectations of next year may be under pressure itself. As a result of which, they believe that there could be some downside risk. Apart from that, they expect growth in FY24 to be volume-led as against price-led, which was in the last couple of years because of high raw material inflation. And the 30% up move that we've seen in Britannia over the last 12 months leaves little room for upside. They've cut their FY23 to FY25 EPS estimates by 1 to 11 odd percent. But it will be important to see where the stock goes from here, primarily because raw material prices have actually cooled off as well. Wheat is down 32% from the top. And will the margins continue to expand or not is the big question. Last quarter they did 19% and the consensus for next year is 17.5%.
Okay, so that's on Britannia. But I'm very interested in Nykaa because I was going through that Macquarie report and they make 2 points, right? Yep. They, of course, talk about competition, which is in the form of Reliance, Astera, but also on the fashion business, they're saying that now people are going out and shopping, not as much e-commerce. So that's a big threat. That
is a big threat. In fact, so the two things that you spoke about, the two big growth drivers for Nykaa, one is their core beauty business. The second one is the growing fashion business. On both of them, they are a little uncomfortable. They've initiated with underperform and a target price of 115. Remember, the stock has already corrected a fair bit from the peak, over 60%. They say the risk in the beauty segment, which is the core of their business, is on the margin front. Why? Because now the next leg of growth will come in from smaller towns. The company will expand, offline as well. And then the competition threat would keep the margins in check. The revenue driver of the company would have been the fashion business. Out there, their physical retail experience says that, the company's own brand focus and curation-led positioning in the fashion business, which is other brands coming in on their platform and then their own brands, all of this at a time when people are shopping offline as well, could impact their growth. And over and above all of this, they don't have, because it's a newer company, they don't have a long operating history. So limited operating history plus need for investments in growth makes them cautious on their EPS estimates. So which is why they are a little circumspect.